Welcome back. The Treasury market sees a different path for the Fed. It's a common opinion, the common consensus is that the Federal Reserve is going to cut rates several times this year. The Treasury market might be telling us a different story, and this is, I think, a very unusual situation. This is on Reuters. Traders keep bets the Fed's rate cuts will start in May. They said in part the futures market reflects about a 48% chance of a rate cut at the Fed's March meeting and a 90% chance of a rate cut by the end of the April-May meeting. Now, we've spoken about this several times this past week. Currently, the futures market predicts a 48% chance the Federal Reserve will cut rates in March. These purple bars represent the March meeting, the probabilities of a cut. Now, certainly it has gone down since mid-January. Nevertheless, there's still a reasonable chance, according to the futures market, that the Federal Reserve will cut rates in March. And the May meeting, those odds are near 100%, pricing in near a 100% chance that the Federal Reserve will cut rates. Well, what does the Treasury market tell us? Well, we can see here, for example, the 10-year bond. That is up 7% in terms of yield since the beginning of the year. The 1-year bond is up, well, actually down 0.2%, basically flat. So the 10-year bond yield is going up. The 1-year bond yield is not. It's flat. What does this mean? Well, short-term bonds, they move closest to the anticipation of the next Federal Reserve decision. Short-term bond yields are shorter the maturity. A 1-month or a 1-year bond is much more reactive to what the Federal Reserve is going to do. Long-term bonds are a reflection of economic strength. If the economy is growing over the long-term bonds like the 10-year bond, those yields will rise. Well, this is what the Treasury market's telling us right now. The blue line, that's the 1-year bond, yellow, 10-year bond. The white bars represent, by the way, the 10-year spread, the difference between the 1 and the 10. We currently have, of course, an inverted bond market where the 1-year has a higher yield than the 10-year. Now, we can see currently what has happened between the beginning of the year and now. The spread between these two bonds, the 1-year and 10-year, has narrowed quite a bit. Take a look at the spread. It is moving to the upside. How did this happen, though? It was the result of the 1-year bond yield not really moving. Remember the prior chart, it was down only 0.2% versus the 10-year bond yield up 7% since the beginning of the year. So in the past 3 weeks or so, the 10-year bond yield has increased. 10-year bond, remember, long-term bonds reflect economic growth over the long term. So, over the past 3 weeks, the 10-year bond is telling us we like that GDP number. We like some of the other economic reports that are showing a strength in the economy. The 1-year bond, remember, that tells us, short-term bonds tell us what the Federal Reserve is most likely going to do in the next meeting. And right now, that's telling us nothing. If the Federal Reserve, if the bond market, if the Treasury market truly believed that the Federal Reserve is going to cut rates soon, we would most likely see this 1-year bond yield go down a lot and quickly. Now take a look, case in point, 2008. At that time, we had actually in '07, we had an inverted bond market. That's when the blue line, the 1-year bond, was above the 10-year. All of a sudden, the economy got itself a lot of trouble. And the Federal Reserve, there was an anticipation the Federal Reserve was going to cut rates. And when that anticipation came to be, the 1-year bond, the blue line, really fell apart. It went down much more fast, much quicker than the 10-year. And that spread widened the difference between the two. Because again, the 1-year bond is very reactive to Federal Reserve decisions. The 10-year bond moves in anticipation of long-term economic growth. So if if the Treasury market believed the Federal Reserve was going to cut rates soon, we would see the blue line go down like it did in '07. But it's not. This is what it looks like now. What it looks like now is that the 1-year bond's telling us the Federal Reserve's probably not going to move anytime soon. And the yellow line, the 10-year bond, is telling us, well, the long term, the economy looks strong. So we have a difference of opinion between the futures market and the Treasury market, which is actually kind of an unusual situation. Which one is right? Well, at the end of the day, only time will tell. Personally, I think that it's better to defer towards the larger market, which is the Treasury market by far. But at the end of the day, we want to see agreement. So we're going to watch both of these very carefully. And when both of these markets really start to tell the same story, let's say the futures market changes its stance and takes away the idea that we're going to cut rates anytime soon, well, then perhaps that will be the case. On the other hand, if the Treasury market starts to move down, especially the 1-year bond yield, if that really starts to move down, then I think we're much more likely to expect the Federal Reserve is going to cut rates as aggressively as many people think. Unusual situation, thought it was quite an interesting story, and we're certainly going to keep an eye on and update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.